Hey everyone, this is Kirk here again at Option Alpha, and today's video we're going to cover once again option time decay, or as it's more commonly known as the Greek theta in option pricing models. So simply speaking, option time decay is really easy to understand once you wrap your head around it. For stocks don't have any time decay feature to them because they have no expiration period. You can theoretically buy a stock and hold it for 50, 60 years if you want to, and so long as the price that it's at now is higher than where you bought it, you can make money on it. Very simple, very easy to understand. That's why a lot of beginners get into stock trading as opposed to options trading right off the bat. Now with options, you have another added feature to your trading parameter or your trading strategy. Not only do you have to guess the correct direction of the market, whether you're buying puts or selling calls or buying calls and selling puts, whatever it is, but you also have to guess how fast the market will move. And this adds another layer of complexity to options trading, but it's very easy to understand once you wrap your head around it, this whole concept of time decay. And basically it just means that the option is going to lose value every day that it doesn't meet that strike price or hit that strike price. So we're going to quickly take a look at some pricing sheets here for options trading early in the morning. And I'll just go back to my Thinkorswim platform, which you can now see. It's about Friday, 8 a.m. here on the East Coast, so the markets haven't opened yet, so these are pretty stagnant prices as of right now. But I think it drives home, again, like some of the pictures in the post, some of the features of time decay. So you'll notice here that I've opened up two separate contract months. So this is for the SPX, or the S&P 500 index. And you can see there's February 2011 contracts, which have 27 days. And then I also have opened up the March contracts, which have 55 days. So you can see 55 days until the last trading day. So again, these February contracts, since they have a shorter lifespan, are actually going to lose value much quicker than these March contracts. And I'll show you just in a minute how much value is left at different intervals. So let's just take, for example, these easy calls right here. These are the 1290 February calls. And you can see under the theta category here, the T theta, that these calls have a negative theta of 0.34. So if we look down at the March ones, you can see that the same exact strike price, just 1 month out, has negative theta of 0.26. So basically what this means is that these February options are going to lose about 34 cents per contract every day just based on time decay. If the market were to stay completely flat that day, they'd lose $34 even though the stock went nowhere. On these February or March options, you lose a little bit less. You're still losing money because the contract is getting 1 day closer to expiration, but you're losing just a little bit less money every day. We understand that definitely the option contracts with a month further out have less time decay. And even just for sake of simplicity, if we go out to the Aprils, which have 83 days, you can see they have just a little bit less. Now we know that time decay speeds up exponentially as we get closer to expiration. Now the other thing I like to show people all the time is this difference between intrinsic value and extrinsic value. So we know that intrinsic value is value of options that are in the money. So that's why there's a breakout in this shady region. And intrinsic value never changes. It's not based on any time decay volatility factors. So you can see that, for example, for these February 1280 calls, the intrinsic value is 26 cents, and the same thing for these March 1280 calls as well. Now the extrinsic value is the value that's left to time decay, and that's this higher feature here. For these March 1290 calls, it's 24.40, and for these February 1290 calls, it's 14.95. So you can see there's less value for options that are closer to expiring. And again, this whole theory of time decay, that the option will lose value as we get closer to expiration. Now, of course, it works in the same category over here in the puts, just in the opposite direction. Okay, hope this has been a great video, and as always, please email us with questions or comments, and happy trading.